Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And in today's episode, we are going to review some strategies for getting a bit more defensive in your investment portfolio. I think we're all getting a little bit of tariff fatigue from all the noise in the media right now, but it definitely continues to be a big factor as we consider investment portfolios going forward. And a lot of investors are asking, a lot of advisors are asking, what tools do we have in the ETF front to get more defensive in your portfolios? Before we get started, a quick reminder, we're not providing investment advice or recommendations. Today is all about education and information. Joining me today is Tony Dong. Welcome back to the channel, Tony. It's great to have you today.
It's always good to be here.
Our viewers will know Tony from his written work. He's written for a lot of different publications, including The Motley Fool, The Street, Benzinga. But what you might not be aware of yet is that he's recently launched his new venture, ETF portfolio blueprint.com, where he analyzes ETFs across Canada and the US, producing very in-depth and timely pieces. So I encourage everybody to check out ETF portfolio blueprint.com to follow Tony. All right, Tony, let's jump into the topic of the day, defensive investment strategies, very topical subjects given today's markets. What, from your perspective, are the big risks that we're facing in the market right now that investors need to be prepared for?
The first one is just valuations are very stretched. The market's run very hot for quite a while, a consequence of the zero interest rate policy of the last decade. And then nowadays you have of course, the AI-induced surge, and then a few more things on the horizon, like quantum computing, sparking a lot of excitement. But also, it's getting to a level where we could start to call it irrational exuberance. And there's a variety of indicators you can use to quantify this. My favorite one is called the Shiller PE ratio. It basically looks at the cyclically adjusted price to earnings ratio for the S&P 500. So right now, today, we're sitting at 37.53, which is well above the historical mean of 17.21 and the median of 16.03. For reference, the highest this has ever been was at the peak of the dot-com bubble, December 1999, where it hit 44.19. So the takeaway from this is that when this is elevated, usually the next decade of equity returns tends to be quite muted. And we saw this in the aftermath of the dot-com bubble, where US stocks experienced an entire decade of negative real returns. It was called the lost decade. So after inflation, US stocks actually lost the bonds. And the other indicator is called the Buffett indicator. It is named after, Warren Buffett. And it basically looks at the total US stock market value divided by gross domestic product, or GDP. And it's expressed as a percentage. Right now, the Buffett indicator is running very hot at about 211%. So this is about 67% above the historical trend line. So 2 standard deviations over. And when you combine this with the fact that Berkshire Hathaway's cash pile has now hit $34 billion, the smart people in the market are looking at this and they're urging caution. And the last thing that I want to, kind of show listeners why valuations are stretched is the current earnings yield of the S&P 500. So the earnings yield is simply the inverse of the price to earnings ratio. You divide it into 1, and right now it's sitting at 3.363%. So for every dollar the S&P 500 makes, you're earning about 3.36%. The interesting thing to note here right now is that the S&P 500 earnings yield is actually lower than the US 10-year Treasury bond yield, which sits at 4.17%. To put it plainly, the companies in the S&P 500, on average, their earnings are delivering less power compared to a comparatively risk-free 10-year debt obligation from the US government. So no matter what way you slice it, stocks are expensive. And I want to preface this is that we're not trying to time the market, but you got to be aware of this stuff, because there is a good possibility that perhaps for the next few years, equity returns will be muted. And we've seen Bank of America, we've seen Goldman Sachs, their equity research teams say along the same lines.
For sure. And of course, it depends on your time horizon. We're not suggesting everybody move to cash. And if you do have that long-term time horizon, it's a good idea to stay in the markets. But a high level Uh, what are the different levers that investors can pull to get more defensive in their portfolio? Cash being one of them, but what are the other ones?
So it's a function of minimizing market risk. So you earn what's called a market risk premium by being invested in stocks. As an equity holder, you are last in line to get paid if something happens. You take on more risk, but for that, you're compensated. So if you want to decrease that, you're going to be decreasing your expected returns a bit. You can reduce market risk by allocating to non equity asset classes. So, for instance, this includes fixed income. But not just any fixed income. You want to allocate towards fixed income instruments that have a combination of high credit quality, and low interest rate sensitivity. So think something like short-term treasury bonds, either issued by the government of Canada or the US Treasury. Both of these have virtually no risk of default. I say virtually because a sovereign default is always a tail risk, but they also have low interest rate sensitivity. So their yields tend to fluctuate with short term interest rates. In terms of other strategies, if you want to stay invested in equities, you can go for what's called a low volatility strategy. The specifics depend on the fund you're using, but a lot of these screen for beta, which is a measure of how volatile and sensitive a stock is relative to the broad market. There's also a related category of strategies called minimum volatility. They're not the same, so don't conflate them. Minimum volatility strategies use a fairly complex mean optimization framework where they consider not only the individual volatility of a stock, but also its correlation to each other. So the goal of that is to build a portfolio that is in the aggregate less volatile. So those are the two. And of course, you have more advanced derivative strategies. For instance, using options, you can build various options legs that mathematically guarantee a certain payoff profile. For instance, mitigating the first 5 to 20% of losses over a specific time period. These are called buffer ETFs.
Mhm.
And of course, finally, you have other ETFs that attempt to trade and produce positive returns irrespective of the market conditions, such as a long short strategy, where you're perhaps shorting overvalued stocks and going long undervalued ones. And that, if executed properly, can smooth out your returns during volatile periods.
All right, so lots of different options from the sounds of things. Of course, you can play with that asset mix, you can increase your fixed income exposure. Then there's a bunch of different ETF strategies depending on your needs and your desired outcome that you can go into. And we will touch on a bit of those, go deeper on those as we get into it. But curious, Tony, if there are any common mistakes that investors make. Of course, we talk about not wanting to time the market. It's about time in the market, not timing the market. But what are common mistakes investors make when trying to go defensive in their portfolios?
I would say over allocating and that coupled with timing is a big thing. It's not uncommon for investors to do what we call fighting the last battle. So after a very big correction, they might shift a good chunk, say 40% of their assets into a government bond ETF. I would say if you're going to be defensive, it's good to revisit your investment policy statement, decide, okay, do I need to reevaluate my risk tolerance? And if that is so, write it down concretely that my portfolio will include X percentage of whatever safe asset, whatever hedge you want. It prevents you from making these rash decisions. And the other one that I tend to see are investors who buy these so called tail risk hedges. So things like put options, right? Which can protect you from a downturn, but you have to fork over a premium and they don't last forever. They decay over time due to what we call theta, which is the time decay in the value of an option. Also, some investors use things like VIX futures. The VIX is a index of volatility. Tends to go up when the market is going down. Not always, but more or less most of the time. And you can buy futures contracts that track these. However, these also decay over time due to a thing called contango, and also the fact that the VIX is mean reverting. So the mistake here is that some investors will pay for these hedges and it incurs what we call negative carry. That over time, you got to pay every day to keep this hedge in place. And over a long enough period of time, the payoff from that eventual crash may not be worth all the premiums you paid. So think about it as a very expensive insurance policy. And just from my experience with those, is that they tend to be worth more than they provide.
For sure, it can be an expensive strategy at times. Um, you did a really good article that I saw on LinkedIn the other day about the cockroach portfolio, and we did an episode last week introducing our new sector spider ETFs that we've brought to Canada. But I'm hoping you can walk us through what you mean by a cockroach portfolio and what you outlined in this as it pertains to sector investing.
The cockroach portfolio is kind of my expression of the power of diversification. So what it does is that it just equally weights the three most structurally defensive sectors in the S&P 500. So from my memory, that includes consumer staples, healthcares, and utilities. And we say these are structurally defensive because they all benefit from inelastic demand. That is, regardless of the economic circumstances, consumer demand for, say, healthcare products, for goods and food, and to keep their lights on and water flowing tends to remain fairly stable. And what this translates to is less volatile earnings for these companies and a lower beta during these periods of market turmoil. Now, what I found on my website, and you can see the back test there, is that equal weighting each of these three sectors and rebalancing them quarterly over a 20-year period has produced better risk-adjusted returns versus the S&P 500 and a 60/40 portfolio. It didn't beat them in total returns, but it came very close. But it did so with substantially lower year-to-year fluctuations, and the max loss that it saw was 15% during the 2008 financial crisis, a time during which the S&P 500 drew down by 55%. So it's really my attempt at making an anti-fragile portfolio that keeps you in the market without having to rely on fixed income, without sorry, it does use some fixed income. It uses government bonds and it has gold, but it's one that doesn't rely on fancy protections, and you can make it for very cheap with sector ETFs. In the US, the sector ETFs go for 9 basis points, and the new BMO ones aren't that much more expensive, and you get to avoid currency conversion costs.
Yep, 19 basis points, and as you said, you have your option on hedged or unhedged there. Yeah, I like that theory of sort of an all-weather resilient type portfolio using sectors that are less cyclical, of course. You mentioned factors and min vol or low vol. Um, Talk to us a bit more about, factors in general, which ones are going to skew more defensive out of the, I think, seven recognized factors, but how would you go about doing that from a factor perspective?
It depends on the particular economic climate. I say generally low vol and min vol strategies are just kind of a good all around base for a lower risk portfolio. These are very suitable for core holding. What we tend to see is that min vol strategies tend to be more sector neutral. That is, their composition more or less mirrors a sector because, once again, their goal is to construct that portfolio in the aggregate that is less volatile. Whereas low volatility strategies, because of that beta screen, you tend to be overweight to the defensive sectors I mentioned earlier naturally. So there's no harm in having both of them. You basically diversify your diversifiers. There are other strategies that may outperform during certain economic conditions. For instance, in 2022, one of the factors we saw outperform was high dividend yield.
Mhm.
When bonds and stocks both drew down as a result of rising rates and inflation, and growth stocks suffer, there's a rotation to value. And the interesting thing a lot of people don't realize is that a high dividend yield strategy actually provides very good exposure to the value factor. It's kind of I say it's kind of a proxy. Of course, you have the yield as well, but honestly, that doesn't matter too much because it's just coming out of your total returns anyways. Dividends are not free money. But, under economic conditions like we saw in 2022, high dividend yield can outperform. And of course, there's also quality, right? So companies with low accounting leverage, with high return on equity, may have less downside than the others. But again, the one thing I do want to emphasize is that all these strategies are still equities. Yes, during like a grinding bear market, you might see them fare better than a market cap weighted approach. But in a sharp, sharp crash like you see during COVID 20, there's a saying out there that all correlations go to zero. And these are going to see big drawdowns because at the end of the day, you're still holding stocks.
Yeah, it comes back to that time horizon, and if you do have the longer time horizon, we know staying invested is the best bet. I think with low volatility ETFs, there's such a wide offering, in Canada and the US in terms of options. So I would just make sure that you are looking under the hood because they're all built differently. Some, of course, using standard deviation, ours, like our ZLB low vol Canadian equity using beta. Um, but I think also an important thing to look at is what are the sector caps on that? Are you going to end up with a portfolio that is just all utilities and staples, or are there certain caps in place that are going to allow you to still have, you know, a well representative portfolio at the end of the day? So something to consider.
Very important to look beyond the name and see how the index methodology, if it's a passive ETF, works, right? And you can find that on the index provider's website. They have the PDFs ready. Make sure you give them a read through.
For sure. Now, you mentioned your cockroach portfolio has a bit of gold in it. So I want to talk a little bit about alternative investments or alternative asset classes in a defensive portfolio. What's the role there and how do they play into the picture?
I view alternatives as once again the diversifying your diversifiers mentality. So, fixed income is normally a great complement to equities because they tend to have low correlations. They're subject to different risks. When you're an equity investor, you're subject to market risk. When you're a fixed income investor, you're subject to credit and interest rate risk. But there are cases in history, and most recently from 2022, where bonds and stocks can fall in tandem. Usually, when one, inflation spikes, and two, as a result of that, rates rise. When rates rise, bond yields go up, which depresses bond prices. So, when you add in a third asset class that's an alternative that is not stocks, not bonds, like gold, it gives you another asset that can zig when the others zag. And from my memory, gold has a low correlation with stocks and bonds. And this makes sense intuitively. It's subject to different forces. The price of gold is not only determined by demand and speculation, but by central bank hoarding. A lot of the reserves have it. It's used in various industrial applications, and people do see it as a flight to safety. In fact, Roman legionaries were paid in gold, and the amount of gold that they were paid for today in the past would buy you the same house today. It really has kept its value for 2,000 years. Now, some people will say gold is volatile. That's the point. When an asset is volatile but has low correlation with your portfolio, that is the perfect diversifier to add, right? And we've seen it this year where gold has been an outperformer. It's outperformed in the previous year. And this is the part where I say, if you're going to include that, don't take that for granted. Make sure you rebalance, right? Bring it back into proportion with what it should be in your allocation.
Mhm.
And then aside from gold, you have other broad commodities too. So things like crude oil, things like natural gas, things like silver. As for the energy commodities and the agriculture ones, they're kind of hard to access in ETF. You have to use ETFs that hold futures. And remember, as with all futures ETFs, you're not really owning the underlying commodity, you're owning a derivative that which price is linked to it. So it may not behave the way you want, and some of these tend to be expensive. So my preference is to just keep it simple with gold ETFs. They are much more liquid, they're much more simple, and they cost significantly less.
And hopefully, when Trump goes to visit Fort Knox, it's all there, right?
Yeah, yeah, that's another risk that you want to be aware with any gold ETF is that the underlying reserves are audited, they're they're allocated properly, they're not being lent out, and not all ETFs do this, so you want to make sure that the custodian and the transparency is there.
Yeah, with our ZGLD, our BMO Gold Bullion, it's actually housed in BMO headquarters, and we can actually go check on it whenever we want. So it's physically stored on the premises, which is good to know, I think.
Absolutely.
Um, you mentioned a lot of different ways, but I just want to throw it back to you and see if there's anything that we missed in terms of strategies you wanted to highlight for investors looking to take some risk off the table.
Yeah, so fixed income exposure. I see a lot of investors. They use the so-called Canadian couch potato portfolio. That it usually includes a healthy dose of ZAG, which is the BMO Aggregate Bond ETF. There's nothing wrong with ZAG. It's perfectly great for what it does. For 9 basis points, you get exposure to the entire investment grade Canadian bond universe. You have mortgage-backed securities. You have investment grade corporate bonds. You have government and provincial treasuries. All that. The problem is in terms of like safety, it's not the safest option out there. It's absolutely the cheapest and one of the most diversified. But during these bad market crashes, you could still see some losses there because of the allocation of corporate bonds. These are issued by companies. They're not risk free like treasuries are.
Mhm.
And also in years like 2022, ZAG has a longer duration. If my memory is correct, around 6 years or so.
Yeah,
So, given a 1% increase in interest rates, you're looking at around a 6% decrease in net asset value, all else being equal. So, the ZAG has credit risk and interest rate risk. And long term, if you stay the course, you should be compensated for this. But if you want safety with fixed income, my suggestion is maximize credit quality, minimize duration. So something like ZGB, which is the BMO Canadian Government Bond ETF, right? That's only provincial and federal issues. You can get even safer with ZFS, which is short-term federal issued securities. And then if you're not too worried about credit risk and you just want to minimize interest rate risk, something like ZST, which is the ultra short-term bond, is a great money market or cash equivalent.
for sure. And I think we missed structured outcome ETFs as a way to take some risk off the table. Buffer ETFs. What are your thoughts there?
the way to think about these ETFs is as a set of training wheels on your bike. You're scared of riding a bike, so you put training wheels on there, and they kind of limit your range of motion, but they prevent you from taking a really bad fall. And I find these are useful for investors who want to remain invested, but want to do so with a mathematical guarantee, a cap, and on their losses and their gains. So, like I said, there's no sense in taking a lot of risk if you can't stay invested, because then you don't earn anything at all.
Yeah.
Your typical buffer ETF will usually work something like this. They'll have a reference asset like the S&P 500, and the first thing they'll do is say buy a put option 5% out of the money, and then they'll sell another put option, say 20% out of the money. And then what this does is that for if the index drops by 5%, you're going to eat that loss. But if it loses between 5 to 20% over that year, you're insulated. You're only going to partake in losses again when the buffer is exhausted past that 20% cap. But this doesn't come for free. To finance that put spread, the ETF also needs to sell what's called a short call. So it sells a call option on the index, which provides an upside cap to your returns. The good news is that buffer ETF providers, including BMO, make these metrics very apparent on the website. You can see, how much of that cap and buffer is still left, how much downside is left, how much upside is left, and also the outcome period. It's very important that when you buy one of these ETFs, you buy it at the start of the outcome period and hold it to the end, because the cap and the buffer is only accurate when you do that. If you buy somewhere in between, you're going to get different outcomes there.
Yeah, very good point. And full transparency on the website. But for those who do want the guarantee, that is an option to look at. Absolutely. Thanks so much, Tony. That was a very in-depth convo. We covered a lot. I encourage everybody to check out ETF portfolio blueprint.com to get more of Tony's insights. And I really appreciate you being here, Tony.
I appreciate coming on to talk to your audience as well. I just want to stress to everybody that risk management is very underappreciated, but highly important. And a lot of us take it for granted until, you proverbially get punched in the face. So the best time to assess your risk tolerance and make changes is before the storm hits.
Yeah. Yep. And we are there right now, I think. So thank you so much, Tony. Next week, we're going to be taking a break. It's March break here in Ontario, but we will be back the following week. So thanks for joining us. We'll see you next time. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.